Day trading is a short-term trading strategy where individuals buy and sell financial instruments, such as stocks, currencies, or futures, within the same trading day. The goal is to capitalize on small price movements, closing all positions before the market closes to avoid overnight risk. Day traders rely on speed, market knowledge, and timing to generate profits from frequent trades. The key principle of day trading is leveraging market volatility. Price fluctuations within a single trading session provide opportunities for traders to buy low and sell high, or sell high and buy low if short selling. For instance, if a stock starts the day at $100 and rises to $105 before noon, a day trader might buy shares at $100 and sell them at $105, pocketing a $5 per share profit. Day trading requires a significant amount of focus, discipline, and risk management. Traders typically use charts, technical analysis, and tools like moving averages or candlestick patterns to identify entry and exit points. For example, if a stock breaks above a resistance level on high volume, a trader might interpret this as a buying opportunity. Similarly, indicators like RSI or MACD help traders decide when to enter or exit a trade. There are different styles of day trading, including scalping, which involves making multiple trades to capture small profits, and momentum trading, where traders look for stocks showing strong price movement. For instance, news about a company beating earnings expectations might cause its stock to surge, and a day trader could ride the upward momentum for quick gains. Day trading often involves leveraging margin accounts, which allow traders to borrow money to increase their buying power. This magnifies potential profits, but also increases risks. For example, using leverage to buy $10,000 worth of stock with only $5,000 in cash can double returns if the trade goes well, but it can also amplify losses if the price moves against the trader. Day trading comes with significant risks. Prices can change rapidly, and traders may lose money if their predictions are incorrect. Transaction fees and commissions can add up quickly with frequent trades, eating into profits. Additionally, the psychological stress of day trading, with its rapid decision-making and financial stakes, can be challenging to manage. To mitigate risks, day traders use stop-loss orders to limit potential losses and position sizing to ensure no single trade jeopardizes their account. For instance, a trader might set a stop-loss at 1% below the entry price and limit trades to 2% of their total account value. In the US, day traders with frequent activity must meet the pattern day trader rule, requiring a minimum account balance of $25,000 in a margin account. This ensures traders have enough capital to handle the risks of frequent trades.